Good morning, everyone, and welcome to today's class called Sale of Home. We're going to be taking a close look at the important rules that we should be aware of when we're dealing with the sale of a personal residence. And we're just going to quickly flash past the course objectives and the table of contents onto page 3 of the manual, where we're going to be looking at the introduction. And to start our introduction, your home is considered to be a personal use capital asset. And the following tax rules normally apply to the sale of personal use capital assets. Firstly, if you have a loss on the sale of a personal use capital asset, that loss is not normally reportable, and any loss that you might have is not deductible. Conversely, if you sell a personal use asset for a profit, that is at a gain, then the gain on the sale of that personal use asset is taxable. So the IRS doesn't give, but it sure wants to take in that scenario. Now, when it comes to the sale of your main home, though, special rules may allow you to exclude a portion or all of your gain from the sale, making the sale of the home a tax-free event. And today's class is going to describe the rules surrounding the sale of home and how to determine what portion of the gain that you have from a sale can be received tax-free. Just briefly, we're going to look at some rules that were in place prior to May 7, 1997. That was a rather important day in the history of sale of home, because on that day, new rules took place. And prior to that day, there was no such thing as an exclusion on the sale of your home. The rules back then were very, very different. And because the rules were so different back then, there are some people who are still confused. They actually think they remember rules from the past and they intermingle them with rules of the present. And so we're just going to briefly discuss how things used to be before we get into how they are today. So there is room for confusion for some people when it comes to the sale of home, and that's because the rules for sale of home changed completely beginning in 1997. Many homeowners currently own homes that they bought under rules that existed in 1997 and earlier years. Did you file Form 2119 to postpone gain on the sale of your home before May 7, 1997? Because prior to May 7, 1997, gain on the sale of your home was fully taxable. However, if you bought a replacement home that was equal to or greater in value than your old home, then you would have filed Form 2119 to postpone your gain. Postponement of gain on the sale of your old home effectively reduced your cost basis in your new home. And this is relevant today if you are trying to calculate the gain on the sale of a home for which you previously filed Form 2119. There also used to be something called the Once-in-A-Lifetime Exclusion of $125,000. This particular exclusion was available only once in a lifetime, and it was available to taxpayers who had reached age 55 or older. This particular rule has been rescinded, but while it was around, I used to commonly run across people who would talk about the fact that they were waiting to turn age 55 so that they could sell their house. And, of course, that's no longer necessary because we have a much better exclusion in play today, and that exclusion came into law effective May 6, or actually May 7, 1997. So if you sold your home after May 7, 1997, these rules apply. But if you have a home that you owned prior to May 7, 1997, and then you sold it, say in 2014, you do need to account for the fact that you may have a gain that you deferred when you purchased that home that you just sold. For example, back in 1992, Sarah buys a house for $60,000, and she lives in that house for 2.5 years and sells it for $100,000. So she has a $40,000 profit, and under the rules of the day, she would have had to pay tax on that profit unless she did something, and that something was purchase another home within 2 years of equal or greater value than the house that she sold. It happens to be the case that she pretty much simultaneously purchased a new home costing $150,000, and so she was able to defer her gain of $40,000 on the sale of that old home when she purchased the new home, costing $150,000. But interestingly, because she deferred her gain on the sale of that old home, that $40,000 of deferred gain subtracts from her cost basis on the new home. So instead of having a cost of $150,000, she has a cost of $110,000. And let's just suppose she continues to live in that home for 20 years and then finally turns around and sells it. She's going to have to remember all the way back to that pre-1997 era era when she purchased that home and had deferred gain in it, when she is looking at how much gain she may have in the modern day. So let's take a look at the modern day now. In the modern day, we are able to exclude the gain on the sale of a home under Section 121 if the rules are met. You qualify to exclude the gain on the sale of your home if you owned and lived in your home for 2 of the past 5 years. Now, the home has to be your main home, and your main home is generally the home that you live in most of the time. If you own 2 or more homes, then only one of those homes is your main home. And your main home can be any of the following: a house, a houseboat, a mobile home, an apartment, a condominium. There is a reduced maximum exclusion that can come into play as well. And generally, you may only claim the exclusion for gain on the sale of your home once every 2 years. However, you may still be entitled to claim a partial exclusion if you sold your home sooner than 2 years after you last claimed the exclusion, or sooner than 2 years after you purchased your home, if you sold your home because your health changed, you changed your place of employment, or other unforeseen circumstances. If you qualify for the reduced exclusion, you may claim the exclusion on the sale of your home for a prorated amount that is based on the length of time you lived in your home during a 2-year period. And here's an illustration of what we mean. Sam bought his home on 10/10 of 12 for $150,000. 1/10 of 14, he moved to Arizona to begin working at a new job. He sold his home for $180,000. Sam can exclude all of his gain using the following formula. He's going to look at the period of time that he owned and occupied the house, which is 15 months, and divide that by 24 months, because 24 months is normally the minimum amount of time he needs to own and occupy. We take 15/24 and multiply that by the maximum exclusion amount for a single person of $250,000. And when you do that, you get $156,250. That is the amount of his reduced exclusion. And it is still more than the gain he has on the sale of the home. And because it's more than he has on the gain of the sale of the home, he does not have to pay tax on his gain. How to figure the gain or loss on the sale of your home? Well, to accurately figure gain or loss on the sale of your home, you must maintain accurate records. If you live in your home for 20 years, you should save your receipts for 23 years. That is for the 20 years you owned and lived in your home and for the 3 years after you sell it. And this is one of the things that is a trouble, or is a lot of trouble for many taxpayers. They get it in their head that they don't have to keep records longer than 3 years, and so they start shredding them. And the thing is that that is not a caveat or a blanket-all statement when IRS says maintain records for 3 years. You really have to look at 3 years from the time you file a return that you have evidence to support deductions and income amounts reported on the return. And the evidence to support the income and expense amounts, basis amounts, could have been accumulated over a period of many years. So what are the records that you should be keeping to prove that you have a cost basis in your home? Well, you should keep receipts or other written records of any improvements you make to the home, such as landscaping, a new roof, new plumbing, new wiring, improvements like room additions, decks, patios, fences, etc., remodeling costs for kitchens, baths, basements, etc., closing papers from the purchase and sale of your home and from any refinances or home equity loans that were used for home improvement, and records of any depreciation that you have claimed for business use of your home. And here is an illustration of figuring basis on home. Mr. and Mrs. Harper bought their home back in 1990 for $70,000. Their closing papers show that they paid an additional $1,500 in closing costs at the time. Then on 5/10 of 99, they refinanced the home for $150,000 and used all the proceeds of the new loan to remodel and make other improvements to the home. They paid $1,500 in closing costs on that refinance. Then on 8/10 of 08, they refinanced their home again, this time for $250,000, and the proceeds were used to pay off credit card and car loan debt, but a small amount was spent to replace the roof. $5,000 was spent on the roof, and at that time they paid another $2,500 in closing costs. Finally, on 8/9 of 14, they sold the home for $285,000 and paid $17,100 in real estate commissions to their agent and another $2,500 in closing costs. The remaining loan balance owed on their mortgage on the sales date was $243,000. So there's a lot of numbers flying around there, and we need to sort through them to determine what the cost basis in this home is and what the net profit is on the sale of the home. So to figure the gain on the sale, Mr. and Mrs. Harper's home, you must add the following amounts: the purchase price of $70, the closing costs on the purchase, the home improvements back in 1999, the closing costs paid on the refinance in 1999, and the home improvements that were made in 2008. We add all those numbers up and we have an adjusted basis of $158,000. We then take the gross sales price, and from that we subtract closing costs on the sale and commissions paid on the sale to arrive at an amount realized from the sale of $265,400. Well, we're going to take the $265,400 and subtract from that the $158 to arrive at a net profit on the sale of $107,400. Now, no tax will be owed on this $107,400 of realized gain because it is less than the $500,000 excludable gain or exclusion that is allowed under the law for a married couple. Now, back before 1997, this amount would have been taxable unless there was a rollover of the money made into a home of equal or greater value. I can remember how confused clients would be wondering how I could arrive at $107,400 of profit when the amount of cash they walked from the sale with was so much less. So we're going to talk a little bit about how the amount that you walk away from the sale of a home with has pretty much no bearing on the actual amount of realized gain. Money received from the sale does not impact the amount of gain realized. The gain realized on a sale has little to do with the amount of cash received from a sale. And this is true for the sale of your home as well as for the sale of business assets or other income-producing property. Many people are easily confused about the difference between how much money they actually received from the sale of their home and the amount of gain that they realized from the sale. Well, most people aren't so much worried about this particular calculation when they're selling their home and able to exclude it. But I frequently run across people who are selling a vacation home or selling a rental home. And so this conversation of how much profit they really have still comes up. I've had it with a client within the last couple of weeks that they're trying to understand why their profit is so high when the amount they're walking away from the sale with is so much less. And here's an illustration of what we mean. The difference between the money received and the realized gain. Mr. and Mrs. Harper have a cost basis in their home of $158,000, which we figured up here. However, because they refinanced their home in 2008 for $250,000, their loan balance at the time they sold the home was still way up there at $243,000. The net sales proceeds of $26,400 are sufficient to pay off the balance of their $243,000 mortgage and leave them with about $22,400 as cash received from the sale. Thus, the amount they realized from the sale of $107,400 is much larger than the amount of cash that they received from the sale, $22,400. Moving on to reporting the rules or reporting rules for the sale of home. Generally, if you meet the rules for excluding the entire gain from the sale of your home, there is no need to report the sale of the home on the tax return. However, you should still report the sale of the home on the tax return if either of the following is true. Number one, you receive Form 1099-S, which happens quite often, or your gain from the sale of your home is greater than your exclusion amount, in which case you probably got a 1099-S. I see 1099-S's issued when they are supposed to be issued, and I also see them when they're not supposed to be issued, so odds are if your client is required to file a return and report the gain because the exclusion is less than the sale price, they're going to get a 1099-S. And very often, even when the exclusion is greater than the sales price, they still get a 1099-S that forces them to report the sale. Now, prior to 1998, taxpayers were required to report the sale of a home using Form 2119, but Form 2119 is no longer in use. If you were required to report the sale of your home, use Schedule D and Form 8949. If you claim depreciation on your home after May 6, 1997, you should report any recovery of depreciation on Schedule D, line 19, and then complete the Section 1250 gain worksheet. And here's an illustration of how we would figure the exclusion amount and then report it on Form 8949 and Schedule D. On February 5 of 2014, Peter and Betty sold their home for $795,000. The homeowners purchased their home back in 1971 for only $20,000. And over the years, they spent $12,250 on improvements to their home and then paid $40,000 in commissions and other selling expenses. They received Form 1099-S from their title company, calculate and report report the homeowner's taxable gain from the sale of their home as follows. We begin by entering their purchase price, what they paid for the home, and then adding in the improvements that they had, which give them an adjusted basis of $32,250. We then enter the gross proceeds from the sale, $795,000. We subtract out their adjusted basis of $32,250 to arrive at the gain that they have on the sale, $762,750. Next, we look at expenses of the sale, which were $40,000, and also the exclusion amount that they can claim as a married couple, which is another $500,000. So adjustments to their gain are $540,000, and if you subtract $540 from $762,750, you get $222,750. So let's take all of this information now and move over to the Form 8949 and complete it. You can see here that we've got a 1099-S, and one of the rules with Form 8949 is that if you received a 1099-S or a 1099-B, the amount reported on the document needs to match the gross proceeds that are reported on Form 8949. So we've done that. We make sure that we have a match here. We then go over into column E and enter their cost basis in the home. Remember, they paid $20,000 for the home plus another $12,250 in improvements. So that's the total cost basis that they have in the home. Next, we enter the exclusion amount, and we also enter their selling expenses. And there are separate codes for each of those. IRS says that if you are entering an adjustment for selling expenses, enter a code E. And if you are entering an exception for or an adjustment amount for the exclusion of $500,000 in this case, then use code H to represent that. So we've used code E and H both, and the total amount of the exclusion plus the selling expenses is a negative $540,000. And then we show the gain, the taxable gain, that we figured right here as it should be shown in column H of Form 8949. And of course, this amount will then carry over to the Schedule D. And we can see on the Schedule D, we've entered amounts shown on Form 8949 long-term with box F checked. And of course, the homeowners are going to need to prepare a Schedule D worksheet to calculate and pay the amount of tax they owe on that sale. Let's talk a little bit now about recapture of depreciation on the sale of the home. The homemaker illustration that we just looked at was a pretty straightforward illustration. We had a sale, we had a profit, we claimed the exclusion, we claimed some selling expenses, and we're carrying those over to Form 8949 Schedule D, figuring the tax, and we're done. But things can get a little bit more complicated if at some point in the past the homeowner claimed any depreciation deductions on the home. And while most people can take advantage of the $250,000 or $500,000 exclusion on this gain on the sale of their home, there are still instances where the sale of your home can result in a taxable gain even when the overall gain is less than the exclusion amount. If you claim depreciation on your home after May 6, 1997, you must recover depreciation that you claimed on your home to the extent of the amount of depreciation you claimed or your net gain, whichever is less. And here is an illustration coming up. The good news, just before we get into this, is that not all depreciation has to be recovered. There are people who would be holding homes today that they owned prior to May 7, 1997, and it's possible in earlier years of ownership that they did claim depreciation on the home in those earlier years. And IRS says any depreciation claimed prior to May 7, 1997 does not have to be recaptured, but any depreciation claimed after May 6, 1997 does. And so we have an illustration here where we're going to show how that works. Chloe Sullivan sold her home on June 30th, 2014 for $165,000. She used her home for business and claimed allowable depreciation deductions on her home totaling $4,000. Her adjusted basis in the home is $100,000, and she purchased it back on October 10 of 2008. Chloe must recover depreciation she claimed after May 6, 1997. Depreciation she claimed after May 6, 1997 is reported on Schedule D, line 19, and you need to complete the Form 8949 and Schedule D for Chloe as shown on the next two pages. So I'm just going to zoom in a little here so it's a little bit easier to see what we've done for Chloe. And you can see that we've entered the main home sale. We've entered the date acquired, the date sold, the proceeds from the sale, the cost. And the difference between those two numbers is $65,000. So we could say that she has a $65,000 gain that she should be able to exclude. But when you look, we're only claiming an exclusion for $61,000 because that $4,000 of depreciation is still taxable. And so the exclusion cannot include any part of an amount that is for post-May 6, 1997 depreciation. So we're going to move over to the Schedule D and see how that sale is treated here. We go down to line 10 and show that we have a net gain of $4,000. We then move on to page 2 of the Schedule D, and on page 2 we make an entry on line 19. Now the significance of an entry on line 19 is you will read that it says unrecaptured section 1250 gain. See the instructions. And what those instructions tell you is that when you get over to the capital gain worksheet where you figure your tax on your gain, this portion of the gain is going to be subjected to a maximum tax rate of 25%. It's not eligible for the lower 15% or 0% rates. So essentially, unrecaptured section 1250 gain is taxed as if it were ordinary income until you hit the 25% bracket. And then if your income exceeds the 25% bracket, then this particular gain is not taxed at a rate of more than 25%. But ultimately, the gain itself is still considered to be a capital gain. It is carried to line 13 and is reported as such on the 1040 form. Now let's look at another level of complexity. This time we're not just looking at a home that had some depreciation claimed on it, but rather a home that has been used for business purposes. If you use property partly as a home and partly for business, or to produce rental income, the treatment of any gain on the sale depends partly on whether the business or rental part of the property is part of your home or separate from it. Let's look first at you have a part of the home that is used for business or rental. If the part of your property used for business or to produce rental income is within your home, such as a room used as a home office for your business, then your entire home is still considered to be your home for tax purposes, and you should apply the following rules when you sell the home, which was partially used for business. Firstly, you do not need to allocate the basis of the property and the amount of profit realized from the sale between the business part of the property and the part that is used as a home. Also, you do not report the sale of the business or the rental part on Form 4797, and this is true whether or not you are entitled to claim any depreciation deductions. And finally, you must recover and pay tax on any part of the gain equal to any depreciation deductions allowed or allowable after May 6, 1997. So this description that we have right here fits the illustration we just showed right here. Chloe Sullivan had a home. It was her main home. There was a part of it used for home office, and she claimed depreciation. It's not treated really as business income to her. It's just the case that she has to recover that depreciation on the sale. And here we have an example again. Ray sold his main home in 2014 at a gain of $30,000. He meets the ownership and use test to exclude the gain from his income. However, he used part of his home as a business office in 2013 and claimed $500 of depreciation. Because that business office is a part of his home and not separate from it, he does not have to allocate the basis and the amount realized between the business part of the property and the part that is used as a home. In addition, he doesn't have to report any part of the gain on Form 4797. Instead, he reports his gain, exclusion, and taxable gain of $500 on Form 8949 and Schedule D. He also reports the recovery of depreciation on Schedule D, line 19, and on Form 1040, line 13. And here is an example, too. We have a full exclusion of the gain. The facts are the same as in example 1, except that Ray was not entitled to claim any depreciation deductions on his home, and since he doesn't claim any depreciation deductions, he gets to exclude the entire gain. So in this first illustration, because he has depreciation that was claimed, he would have to report the sale. He would complete Form 8949. He would take it to Schedule D. He would do the recovery of depreciation and do the capital gain worksheet to figure the tax he owes on that $500. But in example number 2, assuming no 1099-S was issued, he wouldn't need to report the sale at all. Now let's look at what happens when the deductions you've claimed for business use of your home are for a part of the home that is not a part that you use for personal use. And the rules in that situation are quite a bit different. You may have used part of your property as your home and a separate part of it for business or to produce rental income. Examples of a separate part of property include a working farm on which your house is located, an apartment building in which you live in one unit and rented the others, or a store building with an upstairs apartment in which you lived. The use test is not met for the business part in this situation, and you cannot exclude gain on the separate part of your property used for business or to produce rental income unless you owned and lived in that part of your property for at least 2 years during the 5-year period ending on the date of the sale. If you do not meet the use test for business or rental part of the property, you must allocate the basis of the property and the amount realized upon its sale between the business or rental part and the part that you use as a home. And here we have an example where the gain on the separate part of the property is taxable. Jessica is self-employed and lives in a duplex which she owns. She lives in the larger side of the duplex, which is 60% of the building, and runs her business from the smaller duplex, which is 40% of the building. Jessica has owned and occupied her duplex for the past 4 years. She has operated her business from the duplex for the past 4 years as well. Jessica sold her home in 2014. She can exclude gain only on the 60% portion of the duplex that was her home. She must report any gain or loss on the sale of the business use portion of the duplex that was used for business. Assume Jessica paid $200,000 for the home and she sold it for $300,000. She must multiply that $100,000 gain by 60%, and that would allow her to exclude $60,000 from her income. However, she must still include $40,000 as taxable gain, and she must also recapture and pay tax on any depreciation that she claimed on the duplex after May 6, 1997. Now let's talk a little bit about tax planning, because there was a nice loophole in the law that existed for quite a while, essentially from 1997 through 2008. There was a lovely loophole in the law that people liked to take advantage of, and they would even strategize for that. There used to be this tax planning talk that people engaged in regularly with tax consultants like me. I own this rental property. I'm thinking about moving back into it and living in it for 2 years so that I don't have to pay tax on the profit from the sale. And you could do that repeatedly. You could live in the rental home for 2 years, sell it, exclude the gain. You could then have another rental home that you've owned for a period of time, move into it, live in it for 2 years, and exclude the gain. And there were people doing that probably pretty consistently. However, when the Affordable Care Act was passed into law, one of the things that had to be done is they had to look for revenue to help cover the cost of the Affordable Care Act, and one of the revenue streams was to close that particular loophole. So prior to 2009, a common tax saving strategy was to convert a non-qualified home used for rental, vacation, or investment purposes to your main home. And the 2 of 5-year rule could be met if you made that rental or vacation home your main home for at least 2 of 5 years. But this tax saving strategy no longer applies if the gain from the sale or exchange of your home is allocable to periods of non-qualified use that occurred after 2008. So what is non-qualified use? Well, generally, non-qualified use means any period in 2009 or later where neither you nor your spouse or former spouse used the property as a main home. However, a period of non-qualified use does not include any portion of the 5-year period ending on the date of the sale or exchange that falls after the last date that you or your spouse used that property as your main home, or to any period that does not exceed an aggregate period of 10 years during which you or your spouse is serving on qualified official extended duty as a member of the Uniformed Services, as a member of the Foreign Service of the United States, or as an employee of the intelligence community, and any other period of temporary absence not to exceed an aggregate period of 2 years due to change of employment, health conditions, or such other unforeseen circumstances as may be specified by the IRS. And there is a list of these that you can find in Publication 523 on page 4. Allocating gain on sale between qualified and non-qualified periods of use. To figure the portion of the gain that is allocated to the period of non-qualified use after 2008, multiply the gain by the following fraction. Take the total non-qualified use during the period of ownership in 2009 or later, and divide that by the total period of ownership. And here is, I'm going to give you a couple of examples, one where we end up with a fully excludable gain and another one where we have a partially taxable gain. Firstly, the fully excludable gain. We have a character named William who owned and used a house as his main home from 2008 through 2011. Then on January 1, 2012, he moved to another state. He rented his house from that date until April 30, 2014, when he sold it. During the 5-year period ending on the date of the sale, which was May 1, 2009 through April 30, 2014, William owned and lived in the house for more than 2 years. We can see that he had 32 months of occupancy that he had in the home prior to 2012, and then after he moved out, he had another 28 months where it was used as a rental. Now, since the home was a rental property at the time of the sale, William will need to report that sale on Form 4797. However, because the period of non-qualified use does not include any part of the 5-year period after the last date that William lived in the home, he has no period of non-qualified use. And because he met the ownership and use tests, he can exclude gain of up to $250,000. However, he cannot exclude the part of the gain equal to any depreciation he claimed or could have claimed when he was renting the house. So let's take a look now where we have a partially excludable gain, and this partially excludable gain actually ends up being a pretty complex formula, but it's I would consider this to be a pretty relevant calculation. Not only are you going to be running across clients who have possibly rented their home for a period of time and then moved back into it, it is also possible that you're going to have people who maybe had a second home that became a main home, and then they sold it. So this is a fairly complex problem. The IRS provides 2 very lengthy and I consider confusing worksheets in Publication 523. We're going to go through those as a part of this illustration, and you'll see where we end up when we're done. June Cleaver is single. She bought her home back on May 1, 2004 and lived in it as her main home until December 31, 2012, when she moved to a new home. As an investment, June decided to keep her old home and she rented it out. June rented her home until December 31, 2013, when she decided to end the rental contract and move back in. She owned the total of 3,683 days and lived there until she sold it on June 1 of 2014. June does not qualify for any of the exceptions described in page 4 of IRS Publication 523 that would allow her to treat that period of non-qualified use as a period of qualified use. And I'm thinking that this is a fairly lengthy illustration, and my headset's screaming at me to be charged for a bit, so I'm going to give us a password. Number 1 is SAREK. S-A-R-E-K. SAREK. Okay, back with you. Let's continue on with talking about June Cleaver and what makes her interesting. She owned the home as a main home and lived in it for a long time. She then decided to turn it into a rental and move out. And then after renting it for a whole year, she decided to move back in. And it's that moving back in that is going to create a problem for June. It's going to create a complex series of calculations that need to be done, and it's also going to cause her to have to pay tax on this sale. So June can exclude the gain on the sale of her home to a certain extent because she owned and lived in the home at least 2 years in the 5-year period that ends on the date of the sale. However, her exclusion will be prorated based on the total number of months that she lived in the home and the number of months that the home was used as a rental after 2008. Use the following information to figure June's taxable gain and then complete Form 8949 and Schedule D. So we begin by seeing that she was issued a 1099-S. The gross proceeds from the sale are $270,000. And June kept some records relating to the sale. Firstly, her records show that the purchase price was $100,000. She paid for a title search and also paid back taxes for the prior owner at the time she purchased the home. Then she made some improvements to the home costing $10,000. When she sold the home, she had 2 different types of selling expenses, which would be normal. She had real estate commissions of $16,000 and also other selling expenses for title fees of $2,000. And then finally, her records show that depreciation that she claimed on the home after May 6, 1997 totaled $3,345. We've also got a table here breaking down her period of ownership and occupancy of the home. And you can see that she lived in the home for 43 months between June 1 of 09 and 12/31 of 12. And then she has 12 months in 2013 where it was held for rental use. And then in 14, she had another 5 months of occupancy. So the total months of occupancy in the 5-year period are 48 months. So 4 out of the 5 years, she owned and occupied that home. And 12 months, or 1 year, she held it for use as a rental. And IRS provides 2 separate worksheets in Publication 523 that you were supposed to use to break down and figure out how much tax she's going to have to pay on this sale. The first of these worksheets is how to figure your gain or loss. It's called the How to Figure Your Gain or Loss worksheet, and it's shown on pages 7 and 9 of Publication 523. And then when you're finished with that particular worksheet, you then flip over to pages 5 through 18 of that same publication and complete the How to Figure Your Taxable Gain or Loss worksheet. So the 2 worksheets appear to have the same name, except the first one just says How to Figure Your Gain, and the other one is to figure what your taxable gain is. So we're going to begin first by completing the worksheet that figures the gain. And on line 1 of that worksheet, we're going to determine the sales price, which is everything you received in exchange for your home. Looking at the worksheets, I can see some of the point to the worksheets. The worksheets are providing clues and hints as to the types of things you should be including in the calculation. But where the worksheets finally take you could be a lot improved upon, and you'll see what I mean as we work our way through. So firstly, on the first worksheet, we have line number 1 where we enter the sales price. And in this case, she has a pretty straightforward sales price. She sells it for $270,000, but IRS does want you to pay attention to the fact that you should also include in the sales price the value of any notes, mortgages, or other debts that the buyer agreed to assume as a part of the sale, any real estate taxes the buyer paid on your behalf, the fair market value of any other property or services you received, any amount you received for granting an option to buy your home if the option was exercised, and you add all of those up to arrive at your sales price. It then says if you received payment for personal property, do not include it on the sales price. If you received payment or reimbursement for your employer because of a jobs transfer, do not include the payment as a part of your selling price because that would be included as income on your W-2. If you received Form 1099-S, the gross proceeds for the sale should appear in Box 2, but if Box 4 is checked, the sales price includes non-cash payments. And if you did not receive Form 1099-S, refer to your real estate transaction documents for the total amount that you received on your home. Then we move on to line 2, determine June's selling expenses. And selling expenses are amounts that June paid to sell her home. They include real estate agent commissions in the amount of $16,000 plus $2,000 of title fees that she paid on the sale. So we add those amounts up. We enter the commissions on line 2A, and then we enter the legal fees, which were the title closing charges, on line 2D. We add those up, and we have a number on line F, which is $18,000. Now, the instructions for the worksheet don't tell you what to do with this number. It's just with simple deduction, reading the instructions for Form 8949 and applying other aspects of research, I'm able to tell you that what you need to do with this number is take the $18,000 of selling expenses and enter them as an adjustment to June's gain on the sale of her home. And that will be entered in column G of Form 8949 unless they are otherwise accounted for in the amount shown on her 1099-S. And they're not shown on the 1099-S, so according to the instructions for Form 8949, we're going to carry this $18,000 and enter it in column G, and then we will enter in the preceding column, F, a code E to represent selling expenses. Next, we move on to line 3. Figure the amount June realized from the sale. June will subtract the selling expenses of $18,000 from the sales price of $270 to figure $252,000 is the amount realized from the sale. Her realized sale amount, $252,000, is a nice number, but we actually don't do anything with it on the Form 8949. Then we move on to line 4, determine June's total basis in the home she sold. We take the purchase price, title search that she paid for when she bought it. We also include the back taxes that she paid for the prior owner and the cost of improvements she made to the home. When we're done with that, we end up with a basis for depreciation. And line 4 of the worksheet has you go through and enter all of these amounts to arrive at the basis. And then it doesn't tell you to do anything special with it, but we know by looking at Form 8949 that the basis is actually going to be carried over to 8949, and it will be entered in column E. Line 5, determine basis adjustments that apply to June. June's only a basis adjustment is for the $3,300 and $4,500 of depreciation she claimed while her home was held for rental use. And Worksheet 5 describes many other types of basis adjustments which could apply to the sale of a home, but none of them really apply to June. And you can see that we have line 5B is where we've entered the amount of depreciation claimed because it was used as rental. But there's also basis adjustments that could occur because of casualty losses or insurance payments that were received, first-time homebuyer credit amounts, forgiven debt amounts. I'll leave you to read through those on your own. Depreciation is the most common one we see. And that $3,345 of depreciation that was allowed after May 6, 1997 is not going to be eligible for exclusion when she's figuring the amount of exclusion she can claim. She's going to have to reduce the amount of exclusion she claims by this prior depreciation. Now, one of the things that the worksheet does is it has you figure June's adjusted basis in the home. And we take the $3,345 and subtract that from her original basis of $112,000. When you do that, you get $108,655. But again, reading the instructions for Form 8949, we don't actually carry this adjusted basis to the form. Instead, we carry the original basis of $112,000. We then move over to figure June's gain or loss on the sale. The amount realized from the sale is $252,000. We subtract out the adjusted basis of the home to get the gain on the sale, $143,345. So we've gotten to this point to figure out what her profit on the sale is. How much of this is she going to have to pay tax on? And that's when we move on to the next worksheet, how to figure your taxable gain or loss worksheet. That worksheet is used to determine what the amount of gain June has from the sale of her home that will be taxed. And it accounts for prior depreciation claimed, basis adjustment items, selling expenses, and the sales price. The How to Figure Your Taxable Gain or Loss worksheet is used to determine how much of the gain is taxable by accounting for the total gain depreciation allowed, non-qualified use after 2008, and the allowable exclusion. We're going to begin on line 1 where it says start, and the starting point is to enter that number figured up here. Line 7C, $143,345, that becomes the first number that we enter on the next worksheet. Then it says, read the following tests carefully. First test, you did not use any part of your home for business or rental after May 6. That's not true for June. She did use it for rental after that date. Second test, you, your spouse, or your former spouse used your home as a main residence continuously from January 1, 2009 until the date of sale, or if it is not the case, one of these situations applies. You moved out permanently and did not live in your home again before it was sold. Doesn't apply to June. She did move into it again after she sold it. Number 2, you had a change in employment, a health condition, or unforeseen circumstances. Doesn't apply to June. Number 3, you or your spouse qualifies for the stop the clock exception for certain military and intelligence personnel. That does not apply. So she does not meet both the first test or the second test. So the instructions say to go on and begin completing line 3. June fails both the first and the second tests, so she completes line 3 as follows. And on line 3A, the first thing it wants to know is how much depreciation did she claim. Subtract that depreciation from the gain up here, $143,345. Subtract that from the gain, and when you do that, you have a nice round number. $140,000 is the gain prior to depreciation. Next it says, do you have any non-resident gain? If there were times after 2008 when neither you nor your spouse used the home as a main residence, do the following calculation. Enter the total number of days after 2008 when neither you nor your spouse used the home as a main residence. These are the non-use days. And there were 365 days that she rented it. Enter the total number of days you owned the home for the 60-month period was 3,683 days. You then divide 365 by 3,683 and you get a decimal amount of 0.099. And now we take this 0.099, multiply that by 140,000, and when you do that, we get a gain of $13,860. This is actually the amount of gain that will not be excluded from her income. She's going to have to include that as capital gain income and pay tax on it. Not only does she have to pay tax on this $13,860, she also has to pay tax on the $33,445. So when we add those numbers together, we get $17,205. Now, the worksheet doesn't tell you what to do with this number. But I can tell you that this number is the amount that needs to be showing on Form 8949 and Schedule D as the taxable amount from the sale. So all of the other entries we are preparing on the form, or all of the other entries we make on the form, should total so that when we figure the taxable amount, which is ultimately entered in column G of Form 8949, column G should equal this number, $17,205. So let's move on and do a little bit of a synopsis of what was actually just happening there for the line 3 instructions. Firstly, it says figure the gain without depreciation. We take the overall gain from the first worksheet, subtract the depreciation, we get $140,000. We then figure the percentage of non-qualified use, and that was dividing the total number of non-qualified days into the total days of ownership. And when we did that, we got 0.099. Then we figure the portion of gain that is taxable due to the non-qualified use, and that's take the 0.099, multiply that by 140,000, and you get 13,860. We then figure the excludable gain, and the excludable gain is going to be to subtract the non-excludable gain of $13,860 from the gain on the home without depreciation. And that means we end up with an exclusion amount of $126,140. Figure the total taxable gain. The gain allocated to depreciation is $33.45. The gain allocated to non-qualified use is $13,860. You add those two numbers together and you get $17,205. Now the breakup of these two numbers is significant. The $33.45 plus the $13,860 are both going to carry to the Schedule D, but the $33.45 is also going to be carried to line 19 of Schedule D, and it is going to be used to figure the Section 1250 gain, which remember is taxed at a maximum rate of 25% versus the overall reduced rate that most taxpayers pay in the neighborhood of 15%. Line 4, determine the gain that is eligible for the exclusion. We enter the gain, we subtract out the non-resident gain, and end up with the gain that is eligible for exclusion. Finally, on line 5, we move on to determine June's exclusion limit. On line 5A, we enter June's maximum possible exclusion based on her filing status, and that is $250,000. Then on line 5, it says enter the lesser of the number of days that June used the home as her main home or the days that she owned the home in the past 5 years. Well, she used the home as her main home for 3,318 days, and the number of days she owned the home was 3,683 days. There is another bullet here that says if you claimed an exclusion on another home in the last 2 years, enter the number of days that fall into that period here, and that doesn't apply. So ultimately, the smallest amount from above is going to be the 3,318, and we enter that in. Then it says divide the number that we have here, 3,318, by 730 days, which is the number of days in 24 months, and then enter the total. But if the total is greater than 1, enter 1. And all of this is doing is to see if she's entitled to a reduced exclusion, and the answer is no. The maximum exclusion is available to her. She could qualify for as much as $250,000. But of course, her exclusion cannot be more than her excludable gain, and her excludable gain is $126,140. All right, so we've done 2 worksheets, lots of lines. Let's figure out what we're supposed to do with all of that information. After completing the worksheets, it's time to complete Form 8949, and page 5 of the instructions for Form 8949 that the selling expenses should be shown in column G of Form 8949 and identified by entering code E in column F. The worksheets from publication 23 show calculations for the amounts to be entered on Form 8949, but do a poor job of explaining where the amounts figured on the worksheets should be entered on the form. And so, as a result of that, I created this table to show where the amounts calculated on the worksheet should ultimately be entered. Firstly, the sales price, $207,000. You should enter that on column D. The basis of $112,000, enter that in column E. The prior depreciation, enter that in column G, and code H in column F, and I've also just carried it over here because it's going to be part of the total column G adjustment. We then go on to the exclusion amount. That's a negative $126,140. That will be an adjustment. We'll enter a code H to represent that. Then selling expenses of $18,000. Those are represented by a code E, and we carry over negative $18,000. So when we add up all of these adjustments, we get $140,795 negative. So negative $140,795 is going to be entered in column G. And finally, the taxable gain that we want to see in column H is $17,205. So here we have the completed 8949, main home, date acquired, sold, proceeds from the sale, cost basis, the codes that have been used to determine the amount of adjustment, which is negative $140,795, and the total gain that is going to be taxed, $17,205. We carry those numbers over to the Schedule D, and then on page 2 of the Schedule D, we show on line 19 the depreciation. So the total taxable gain is $17,205, and the amount of gain subjected to the higher rate of tax is $33.45. We've really covered everything that is probably relevant for sale of home already today. It doesn't hurt to read Publication 523. There's actually a lot in that publication, some of it interesting stuff that we're not commonly going to run across, but something that you should just have in the back of your mind. I've covered the things that I think are the most important, but by no means have I covered everything that Publication 523 discusses. And before we go, though, I'm going to bring up a couple of things that can be relevant, although they're incredibly rare. And the first of these is the recapturing or payback of a federal mortgage subsidy. Because if you financed your home under a federally subsidized program, including loans from tax-exempt qualified mortgage bonds or loans with mortgage credit certificates, then you may have to recapture all or part of the benefit you received from the program when you sell or otherwise dispose of your home. You recapture the benefit by increasing your federal income tax for the year of sale. And you may have to pay this recapture tax even if you can exclude your gain from income under the rules that we've just discussed earlier in today's class, because the exclusion does not affect this particular recapture tax. The recapture tax applies to loans that came from the proceeds of qualified mortgage bonds or were based on mortgage credit certificates. The recapture also applies to assumptions of these loans. When the recapture applies? Well, recapture of the federal mortgage subsidy applies only if you meet both of the following conditions. Number one, you sell or otherwise dispose of your home at a gain within the first 9 years after the date you close on your mortgage loan, and your income for the year of disposition is more than that year's adjusted qualifying income for your family size for that year. You have to meet both these tests in order to be forced to pay the recapture tax. You either received proceeds from a qualified mortgage bond or purchased your home under a mortgage interest credit certificate and then sold the home at a gain within 9 years. And at the time you sold the home, your income is more than the adjusted qualified income for a family size for your household for that year. And that's not going to be a fixed number because it's really going to depend on where in the country you live and the mortgage interest credit certificate programs available in that area of the country. So when does the recapture tax not apply? Well, the recapture does not apply in any of the following situations. The mortgage loan was a qualified home loan of not more than $15,000 that was used for alterations, repairs, and improvements that protect or improve the basic livability or energy efficiency of your home. Your mortgage loan was a QHIL of not more than $150,000 in the case of a quill used to repair damage from Hurricane Katrina or any of those other disaster areas. The home is disposed as a result of your death. You dispose of the home more than 9 years after the date you closed your mortgage loan. You transfer the home to your spouse or to a former spouse incident to a divorce where no gain is included in your income. You dispose of the home at a loss. Your home is destroyed by a casualty and you replace it to its original site within 2 years. Or you refinance your mortgage loan unless you later meet the conditions listed previously under when the recapture applies. So how do you figure and report the recapture amount? Well, you do so on Form 8828. And if you are subjected to this recapture tax, it's likely that you're going to receive a reporting document relating to it, and you'll need to complete the Form 8828 to either figure your recapture tax or show that you don't owe it. And this is the form right here. I'll just zoom out a little so you can see a little bit better. And with that said, we're going to move on now to the recapture of the first-time home buyer credit. I've been talking about it for a number of years, and I'm looking forward to the end of it because it's almost like there's just so few of them. I can say that in earlier seasons, prior to the 15 season preparing 14 returns, we did virtually no recaptures of the first-time home buyer credit, but in the preceding years, we were seeing them. So I would say that we're largely out of the window, and that's because when we're talking about first-time homebuyer credit, there are two of them. There is the original first-time homebuyer credit that came out in 2008. It was $7,500, and had to be repaid over a 15-year period. That credit is still being dealt with and will continue to be dealt with really until about 2025. But the other homebuyer credits that technically did not normally need to be repaid, that were issued in the later part of 2008, 9, and 10, all of those years have passed. In other words, the statute of limitations on being forced to repay those credits are now in the past. The only year where we could have had a purchase of a home where the first-time homebuyer credit was claimed that we would need to deal with a recapture for tax year 2013 was for those individuals who purchased homes and claimed a first-time homebuyer credit in 2011. And in that case, it was restricted to a small group of people, mainly the military. Average people couldn't take advantage of it. So we're going to talk more about the rules for the 2008 credit because they continue to be relevant. If you claimed the credit for a home you bought in 2008, you generally must begin repaying it starting with the 2010 return. Beginning with tax year 2010, you must complete Form 5405 and enter $500 on Form 1040, line 60B each year until the credit is repaid. And actually, I believe the 5405 is not required unless there is a recapture because of sale. So now it's just possible to enter the $500 on the line without attaching the form. But you may be required to pay more than $500 back in 2014 if you claimed a homebuyer credit for a home that you bought in 2008 and you then sold the home in 2014 or the home stopped being your main home in 2014. So we have repayment rules for homebuyer credit claimed in 2009, 10, or 11. And since that is such a rare animal and pretty much impossible now that we're into 2015, we're not really going to be considering that at all. I really just wanted to go in and show you how we deal with the repayment of the homebuyer credit for individuals who sell a home and claimed a 2008 credit for $7,500 and are now going through those repayments, but then they sell the home. How do we deal with that on the return? And I created an example for you, and that's Johnny sold too soon. He received a $7,500 credit or loan as a 2008 first-time homebuyer credit. He purchased the home on July 1, 2008 for $250,000, and his adjusted basis in the home is $242,500. That's the $250 subtracting the $7,500 first-time homebuyer credit. Now, Johnny repaid $500 of that credit with each of his 2010, 11, 12, and 13 tax returns, which means he's paid back $2,000 of the $7,500, which means he's got $5,500 of outstanding credit left. Let's see how much of that credit needs to be paid back because of the sale. We have the purchase price of the home minus the 2008 homebuyer credit plus the credit repayment, giving him an adjusted basis in the home of $244,500. We take the sales price of the home, subtract out the selling expenses, and then we also subtract out the adjusted basis to get the gain on the sale. Well, the gain on the sale is less than the unrepaid credit amount of $5,500. So on Form 5405, we enter the selling price of the home. We enter selling expenses related to the home. We enter the adjusted basis of the home. And then we enter the unpaid first-time homebuyer credit. And the taxable amount is going to be the lesser of the amount of credit unpaid, $5,500, or the gain on the sale. And the gain on the sale is the lesser number, and so that is the amount that will be entered as a tax on his Form 1040. So we go over from this worksheet. This is a worksheet. It's not actually the form. This is the 5405 gain worksheet. We go over to the form 5405, enter that tax on line 8, and then carry it to line 60B of his 1040 return. And that's it. We're finished with today's class on the sale of home rules. And for those of you who would like to take a look at the homework assignment is shown on page 34 of the manual. An answer key for this assignment can be found inside the LMS. And if you are a self-paced student, you will need to complete this assignment as well as a final exam. And if you're a live student, it's just there for you to reference for another learning opportunity. So thank you for participating in today's class, and I hope to see you again soon. Bye-bye. Password number 2 is EMU. E-M-U. EMU. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.